In today's stock analysis, we are going to examine the key pillars, look at past results, see what the analysts' predictions are, create a valuation, and review then rate the company. Today we are going to look at Amazon, ticker AMZN. Let's dive into the process I follow when reviewing whether or not to invest in a company. After I've collected all the financial information, I then analyze what I consider to be the 12 key pillars. These pillars are based on the insights and teachings of the best super investors and what I consider to be the key metrics when evaluating a company. Ideally, we would like to see each of these metrics achieve or exceed a specific target. Companies can earn 1 point for fully meeting the target or half a point for coming within 2% below the target. The first pillar is earnings per share growth. This is where we take the net income and divide it by the shares outstanding. For Amazon, earnings per share growth over the past 12 months is 91%, far exceeding the 10% target, scoring 1 point. Next, let's look at free cash flow growth, which measures the money a business can generate from its operations. Warren Buffett emphasizes the importance of strong financial health and prefers companies that can generate substantial free cash flow. Amazon's free cash flow growth is minus 13%, which is negative, scoring 0 points. Next, we come to revenue growth, which tells us how good the company is at generating income before deducting expenses. Amazon's revenue growth is 9%, just under the 10% target, scoring half a point. Now let's turn to book value growth, calculated by subtracting total liabilities from total assets to indicate equity growth for the company. Phil Town believes book value growth is the most important metric, as it has the interest of the shareholders at heart. Amazon's book value growth is 39%, exceeding the 10% target, scoring 1 point. We then assess the management of the business by looking at return on invested capital and return on equity. These measures allow us to evaluate a company's efficiency at allocating capital. For Amazon, return on invested capital is 13% and return on equity is 21%, both above the 10% target, scoring 1 point for each. Now we move on to debt. Joel Greenblatt prefers companies that are able to pay off debt with their free cash flow within 3 years. Amazon's debt would take 4.73 years to pay off, which is above the 4-year threshold, scoring 0 points. With the information we have gathered, it tells us that aspects of the key pillars are solid, but let's explore the company further. Now let's look at the remaining key pillars which help define an excellent business. Let's look at the gross margin, which indicates how much money a company retains after incurring the direct costs of producing its goods or services. This is currently at 49%, exceeding the 40% target, scoring 1 point. Next, we come to the operating profit margin, which tells us how much profit a company makes on $1 of sales after production costs but before interest or tax. Peter Lynch prefers companies with strong operating margins when assessing their financial health and competitive advantage. Amazon's operating profit margin is 11%, which is below the desired threshold, scoring 0 points. Free cash flow yield provides a more realistic view of a business's financial health. Terry Smith prefers companies with a free cash flow yield of 5% or higher. Amazon's free cash flow yield is 1.79%, well below the target, scoring 0 points. Next, we assess the 10-year book value growth as potential shareholders. For Amazon, this is 35%, exceeding the 10% target, scoring 1 point. Lastly, Bill Miller believes earnings growth is the biggest indicator of a company's stock price. Amazon's 5-year net income growth is minus 218%, which is negative, scoring 0 points. In the description, I've included a link to the investors page and the annual report if you want to check it out for yourself. Amazon has demonstrated strong fundamentals in several areas, including EPS growth, return on capital, and book value growth. However, its recent free cash flow trends are low due to recent expansion and investment, which can be viewed as a positive as profits are being reinvested into the company. As of today, the stock is trading at $171. Over the past 6 months, the stock has shown strong upward momentum, reflecting optimism around the company's efficiency improvements, cost control, and AI investments. Due to the recent tariff stock market crash, this presents us with a potential buying opportunity. Looking at the overview, we can see the current market cap is approximately $1.81 trillion. They are currently generating $637.96 billion in revenue for the trailing 12 months and have 10.6 billion shares outstanding. At present, their earnings per share tell us that for each share of stock, the company is generating $5.53. Their price-to-earnings ratio is 30.92, which is above the S&P 500 average of 25.19. According to Morningstar, Amazon has a wide economic moat due to its scale, logistics network, and AWS leadership. The overall consensus among analysts is a strong buy, with a 12-month price target of approximately $264. Analysts are forecasting an average EPS growth rate of 21% over the next 5 years. Let's calculate a valuation. I will use Amazon's current earnings per share of $5.53. Combining historical growth rates and future analyst predictions, I estimate an earnings per share growth of 16%. Assigning a forward price to earnings ratio of 31, projecting 10 years forward, and applying a desired return rate of 15%, this results in a future stock price of about $756. The current intrinsic value is about $187, with a margin of safety at $140. Since the current price is below the intrinsic value, this scores a check. If the stock market crash continues, we could well see it hitting the margin of safety. It all depends on your personal view and outlook for the company, as well as the return on the investment you would like to see. When reviewing the key pillars, Amazon scored 6.5 out of 12, which is a little lower than I would normally like, but this is mainly due to their recent reinvestment into the company, therefore I will give them a check. Over the last 6 months, the stock has experienced strong upward momentum as the company re-accelerates earnings and focuses on efficiency, scoring a check. Analysts are predicting a growth rate of 21%, scoring a check. The current price matches the intrinsic value, signaling a check. According to Morningstar, Amazon has a wide economic moat, which scores a check. My final overall rating is 5 out of 5 stars. While the company remains a long-term leader with compelling growth potential, at a discounted price which could go much lower during this crash. Thank you for joining me in today's analysis. Don't forget to like and subscribe for more insights.